Good evening again, ladies and gentlemen. Well, that was very quick 3 minutes. Thank you all for being here for this session, final session of the day, I think, for most of us. Final formal session. I'm Gerry Baker. I'm the editor-at-large of the Wall Street Journal. I write and do various different things talking about some of these issues that are confronting the global economy, and it's a pleasure for me to be able to moderate this panel on this very interesting and lively topic, which is getting a lot of coverage, obviously, news, but obviously it's a source of concern, I think, for a significant number of people. We've got a really good and diverse panel, I think, which who will be able to offer us various perspectives on the issues at hand, and I very much hope, obviously, that you will contribute. It's very important. We've got a very good audience here, both in terms of quality and quantity, and I would very much appreciate it if you please do feel free to get involved and to interact. Just to frame the discussion, the title is "When the Corporate Debt Bubble Bursts," and I was thinking, as I was pondering this, that there are at least three quite large assumptions in that title. One is that we recognize a bubble and know what a bubble when there is one. Secondly, that we have one right now, and thirdly, that it's going to burst. So I have a suspicion that some of our panel may take issue with one or some of those assumptions that are implicit in the discussion. But we do know that there's been a dramatic increase in corporate debt around the world in the last few years, in particular, obviously steadily growing, obviously since the depths of the financial crisis. It's often cited as a major risk for the global economy. People note, for example, that total corporate debt levels are higher than they were now. Depends how you measure it, obviously, in relation to GDP or in relation to equity prices, but there's no question that there's been a significant increase in corporate debt, driven, of course, by these extraordinary monetary conditions that the world has been experiencing for the last 10 years, and all of the elements and all of the business decisions and all of the balance sheet decisions that companies have been taking that go as a result of that. And so I do want to get at the question: should we be concerned? How big is it? How significant is the corporate debt, the corporate debt expansion that we've seen? How does it compare historically? Are there elements about it that should it concern us overall? Do we have the makings of a bubble about to burst? Is it going to lead to a broader financial dislocation and sort of problems that we possibly not on the scale of, let's hope not on the scale of 2007, 2008, but could we be in for something really quite unpleasant? If not, why not? And I want to explore too some of the specific trends within that, some of the implications of the expansion in corporate debt. Look at it, we've got a very nice, as I say, diversified panel globally, so geographically, so we can look at some of the geographic trends, some of the divergent geographic trends. We've got some policymakers on the panel, and I think it'd be great to get a perspective of the challenges for policy, such as they are, or the need for policy responses, if there is a need for policy responses, both at a national level and a supranational and multilateral level. And we've got two extremely experienced practitioners who are directly involved in the corporate debt markets. So let me introduce the panel, and we'll get straight into our discussion. To my immediate left, Karen Fang, who is the Managing Director, Head of Americas of Fixed Income, Currencies and Commodities at Bank of America Merrill Lynch. And Karen is also a young global leader of World Economic Forum. Welcome, Karen. To her left, we have Felipe Larraín Bascuñán, who is the Finance Minister of Chile. He's been very busy today doing a number of events and panels, and so we're very grateful to have him. Thank you very much for being here. To his left, we have Josh Friedman, co-founder, co-chairman, co-CEO, a lot of co's there, of Canyon Partners. But there'll be no co-opinion sharing, I'm sure. It'll be all Josh's on this panel. Look forward very much to hearing from him. We've had an opportunity to discuss these issues before. And I should say, by remarkable coincidence, because I understand that to his left, David Lipton, first Deputy Managing Director of the International Monetary Fund. You're very familiar with him. All of you who are regulars at Davos, familiar with all of the panel, actually. But I discovered that, I think this is true, that David and Josh were actually at elementary school together, is that right?
And high school, junior high, the whole thing.
So if nothing else, we can think of this gathering as a reunion, for a couple of old school friends. So we have that's a wonderfully, obviously experienced, talented and diverse panel, and I really want to draw out all of the questions that I raised and many, many others that, frankly, I'm not smart enough to know about. So I will start with, if I may, with Karen Fang. Karen, you give us a sense, taking this question head on, of how large is how large has been the expansion in corporate debt, global corporate debt over the last few years? How does it compare historically? And should the world worry about it?
Okay, so can you guys hear? Can you hear? Okay. So first of all, I think let's take a look at some numbers. So let's take a step back and think about global debt. A decade ago, global debt, which is largely divided into sovereign debt, corporate debt, and consumer sector debt, was $100 trillion, give or take. That's a decade ago. 10 years later, we're basically looking at $170 trillion of global debt. So that's 70% higher. But no number should be looked at, in isolation. When you think about that in debt to GDP terms, obviously GDP is growing. We're slowing down in our growth, but GDP is still growing. So a decade ago, debt to GDP was roughly, call it 207% global debt to GDP, based on the $100 trillion number. And today, at $170 trillion, i.e. 70% higher in notional debt terms, the debt to GDP is roughly 232%. So that's 25% higher. This sounds a little bit more manageable. Now, if you take a look at the title of the panel is on corporate debt. Now, corporate debt out of that $170 trillion today is roughly $66 trillion. So it grew by $29 trillion in the last decade. But sovereign debt has actually grown by more. Sovereign debt grew by $31 trillion. So again, everything is relative. But sovereign debt had to grow because we had to, stimulate the economy, post-financial crisis. We probably have just gone through an unprecedented amount of quantitative easing, and global central banks have really coordinated on the monetary easing to inject some life back into the economic and financial system. So there's no wonder that sovereign debt actually grew more than corporate debt. So now zooming in on the corporate debt, $29 trillion increase in the last decade, $66 trillion today. That $29 trillion increase is broken down to $10 trillion in advanced economies and $19 trillion in emerging markets. And now that emerging market increase, which is $19 trillion, is further broken down to $4 trillion by 16 major emerging market countries, including Chile, ex-China, and $15 trillion of that increase came from China. So if you look at, again, just zooming in, because I think my job here is to provide some numbers, is the Chinese corporate debt to GDP now is standing at an astounding 168% debt to GDP. And the US corporate debt market is roughly 74%. And the rest of the 16 emerging markets outside China is at 48% debt to GDP. So one might say, well, that's China debt has, corporate debt has gone up a lot. Should we be concerned? I think, again, we can drill a little bit deeper into the subject a little bit later. My personal view is that you have to get into the details. Because if you think about it, the China GDP is slowing down. It's still growing at 6.5% a year. It's one of the fastest in the world. 95% of the Chinese corporate debt is denominated in the RMB. And that's different from the rest of emerging market countries. That ratio tends to be 2/3 in dollar terms or foreign currency terms. And why is that better? Because you have less currency mismatch risk. Because if you can generate your economy, make earnings in RMB, and you're paying your debt in RMB, and you're not subject to the extra layers of debt service burden when your currency depreciates, when your current economy doesn't do well, and you depreciates against the dollar, and your debt terms is actually denominated in US dollars. And then 10% of the debt in Chinese corporate debt is held externally. So a lot of that debt is held locally. So the jitters in the Chinese corporate debt market has less contagion risk, if you will, into the overseas debt markets. And last but not least, I think in Davos we have heard from the Chinese regulator, they're extremely responsive to market movements. They just cut policy rates, they cut bank capital reserves, they have cut business taxes. So rest assured, I think they will be extremely responsive and use fiscal tools and monetary tools to stimulate the economy and the markets if they need to. So I'll leave it there.
Thanks, Gerard. That's very, very interesting and a very good overview, and provides a number of lines of inquiry, and particularly the divergence between China, the extraordinary role that China clearly has played in the growth of corporate debt in the last few years. I'm very interested to know, and I'll come to the other members of the panel as well in a second. I'd be very interested to know how that, I think you said 160% of GDP?
168%.
How that compares historically with countries that have got into financial difficulties, whether it's something we should be concerned about, or whether it's something that's, given the particular circumstances of the Chinese economy, the particular profile of the debt, both in terms of currency, maturity, and everything else, whether there's something to worry about. But I'll come on to that, and I'm sure David will have some interesting observations on historical and geographical comparisons. But I want to come on to the Minister. Karen talked a bit about the role of emerging market, which has been significant. China obviously accounting for the bulk of it, the vast bulk of it. But from a policy perspective, Minister, as you look at this, what's on your mind? What are your concerns?
Well, thank you very much. Pleasure to be here. We look at it with very deep interest what's happening with the corporate debt. It's not a direct responsibility, but it could create, in the worst case, it could create a crisis, a financial crisis. The first thing is I would like to, going a little bit deeper into the numbers, is that you have to distinguish on corporate debt. What is corporate debt that is owed to the parent company and corporate debt that is owed to banks, to the banking system or financial markets in general? And it's a very important distinction, because the corporate debt that is owed to a parent company is very likely to be rolled over. It's unlikely that a parent company would like to create a service problem for a subsidiary. And when you take a look at the Chilean numbers, for example, which we have done, 50% of corporate debt is owed to parent companies. So it's a way, companies have a way for different reasons to send more debt, and resources are incorporated and contributed more in terms of debt than in terms of just of equity. So it's an issue of how you divide equity and debt in terms of the resources that are spent. A second issue, which is very important, there are countries in this world where you have a luxury of issuing the debt, your debt in your own currency. There are other countries, the normals, the mortals, of this world, that we have to issue a large part of the debt in foreign currency. And then the second distinction here is very important to understand if you have a currency hedge or not. Because if you don't have a currency hedge, you are under an increased, higher vulnerability than if you do. In the case of Chile and our foreign debt owed in dollars, we have over 90% is covered, has an exchange rate hedge. So in case the currency moves, and the event of a crisis, most likely will have a depreciation. If you're hedged, the situation is different. The third thing is the profile of the debt. And you have to distinguish countries by the different profiles. If you're indebted at 5 months, or a year, it's very different than you have very long-term, very long maturities of investment. So I think this is the second look. So my first cut here is that don't take the rough macro numbers, global numbers, and just say, okay, your corporate debt to GDP is so much, you are in trouble. Well, second view is all these issues, corporate debt owed to, parent companies, currency hedge, and maturity. Of course, the conditions, the countries, if you have a low spread, that's another, the terms at which your debt are being. Let me take the policy view now. The policy view is, first, we want to be, as a government, and I must say, I must confess that I've been in office for 9 months, but this is my second time in office. And so I've already been finance minister for 4 years. My wife asked me why did I want to come back, but here I am anyway. So the issue is that if you have, what do you do on the fiscal side? On the fiscal side, we'd like to have very low levels of public debt to GDP. Because overall, you take a country and you say it's not only the problem is not only corporate debt, it's the overall level of debt. So if you take a responsible view to public finances, low deficits, and I would also say if you have a structural rule, as we do have, not just spending according to current income, but to structural income. If you have fiscal institutions like we just approved in Chile a fiscal independent fiscal advisory council, and we have a sovereign fund. So all these institutions help you. Low levels of debt and good fiscal institutions will help you cushion whatever comes from the private sector if things get more complicated. I will also mention on the financial side, a good, if you have improved your legal and regulatory standards. For example, we just passed a new banking law 3 months ago. In the new banking law, we're going to Basel III standards. So we have higher capital requirements, and we have an improved regulatory scheme, and we have a collegiate body of 5 council members to supervise the banking system with a systemic view, not just banks, but also the whole financial markets, And that's a different thing than having a superintendent of banks that looks only at banks. So this is two important changes of the new banking law. Also in terms of the regulation itself, we have by law a Financial Stability Council. Other countries do as well. We meet once a month. It's presided by the finance minister, the central bank president, and the heads of the different superintendency as the head of the Financial Market Committee come and meet, and we follow what's happening in financial markets. We look at corporate debt, we look at public debt, we look at different issues that could draw our attention and could be potentially source of instability, so that we preserve financial stability. That's the aim of that financial body. The other thing is to, I would say, in terms of what we want to do in our country is to look at financial markets with a view to deepen, for example, liquidity. We want to become, and I hope I can convince at least some of my panelists here, we want to become a regional financial center. And we have a very deep financial market because we have a lot of institutional investors that play an important role, among them insurance companies and pension funds. And with that, if we are able to create a deep financial market, we will be in a different position than if we have a shallow market. So I think all these are parts of a broad view of what the government and what policy should do on financial markets, on monetary banking regulation, and on fiscal policy to support, whatever. And we take a view that the private sector, well, they're free to take debt, but they can assume so much exchange rate risk. They're very limited in what exchange rate risk they could assume.
Thanks, Minister. Josh, I'm going to come to you. So far, we have a fairly sanguine view, I think it's fair to say, and I want to provoke, perhaps see if I can provoke you a little bit. Look, I mean, I guess one of the concerns that the reasons that whatever we think of the current numbers and how they compare historically and what they are as a proportion of GDP, we're at a point where, aren't we? We've had this extraordinary 10-year period of monetary accommodation, extraordinarily low interest rates. This debt has been taken on. We are clearly entering, already have in the United States, a period of steady monetary tightening, which can be expected to go on both in terms of short-term policy rates and also quantitative tightening by the Fed. We're going to see more of that in Europe, presumably in the course of the next year or so. So I think the specific concern is not, hey, what are we worried about by, historic standards when maybe we were at we were at different stages in a cycle, but we're at a point in a cycle where we can expect. We're already in the early stages of a tightening cycle, which could be quite significant, and certainly the amount of easing that is to be unwound is combination of rates again and central bank balance sheets is unprecedented. What are the potential risks with this high level of corporate debt that could result as we see this easing unwound?
We did get a little preview of that in the beginning of 2016. The end of 15, the Fed started raising rates. People were worried about deflation from China. Oil prices were going down. And we saw quite a correction in the market, although it then found its footing and recovered, more than recovered. And we got another preview of it last month. A bubble is something that can burst. My entire career, and I suspect everyone's lifetime in this room, bubbles that burst, financial calamities, usually take place when you have a combination of excessive leverage with a liquidity mismatch. So you own illiquid assets, and you have liquid liabilities, and there's gigantic leverage on it. That was the banking, and that was the global financial crisis. And then those things get leaked out into not only in the banking system. If it's in the banking system, it's particularly bad, but even if it's not in the banking system itself, if it's in other institutions. What's happened since 2008 has made that much less likely. And that doesn't mean that we don't have a lot of overheating for all the reasons you said, which I'll come back to. The reason that's less likely today is that in the last 10 years, thanks to regulation, thanks to the desire of bankers not to have a recurring nightmare, commercial bank balance sheets are awfully, awfully good. If you look at the high yield market, commercial banks used to own between 10 and 20% of all the product, and they made very active markets using their own capital. Today, those banks use none of their own capital to take positions, and it's not just because of the Volcker rule. They don't do it anywhere, and they act as actual agents for their clients as opposed to competing with them as principals. So there's good and bad to that. The bad news is, so structurally, they're pretty solid. The bad news is that if you look at the consumers who do own these products, mutual funds, ETFs, hedge funds, and others, the desperate search for yield against a zero interest rate standard for governments has caused passive vehicles to do very well. And there's been this one-way train of capital into vehicles that want to look like the high yield index that benefit from rates going down. And as long as you keep ringing the bell and feeding the dog, then it'll keep salivating every time you ring the bell. And we've been ringing the bell nonstop with mutual funds to own fairly illiquid assets, because the issue of mismatch, i.e. we have to honor daily requirements for capital if we have redemptions, even though we have illiquid assets, hasn't been an issue because it's been a one-way flow of capital in. And the capital comes in, those buyers have to buy because they want to look like the index or something measured off the index. So that's what happens when you artificially set interest rates at a very, very low number. The flip side of that is when that reverses, you get to see the consequences of owning illiquid assets with liquid liabilities. And it's exaggerated by the fact that the commercial banks aren't making markets with their own capital. So if you're seeking a bid suddenly, and we saw outflows at the beginning of 16, we saw it again in the last month, you get some significant problems with pricing. Along the way, you do get some of those debt bubble type characteristics. So for example, there becomes incredible competition among institutions who have pension funds and endowments and others who need that yield to survive to buy things. And you get all that kind of late cycle, overly bullish behavior that causes mispricing. You get poor covenants. You get the debt market's version of fake news, which is pro forma earnings. Note and covenants are not set off of EBITDA, they're set off of some fake EBITDA that manufactured, adding back God only knows what. You have a frenzy of purchase of leveraged loans that are covenant light. They literally have no covenants. And then on top of it, when there is a problem, because the markets are so forgiving and they really want to be able to put money out, the private equity controllers of the companies can act particularly abusive toward the creditors. And then in the very late cycles, it's like when the fall of civilization happens and people start killing each other, you get creditor on creditor violence, and you start getting CDS wars and other kind of credit default swap wars and other things. So we definitely had a healthy dose of that, which made the par loan market and the par high yield markets, at least for us, not very interesting places to reside. But that's very different from a bubble. A bubble is when you have mismatch and leverage. When you have mismatch spread out through a bigger and bigger part of the system, but you don't have the leverage, everybody bears the brunt of that adjustment, and it doesn't damage your financial institution, so you're less likely to have those extreme consequences.
Thank you, Josh, and we'll come back to, I know you've got some other things to say too. David, you've lived through a significant number of debt cycles, both in the public and private sector, in the US Treasury, in the private markets, and then latterly, of course, in the IMF. Give us a sense of where you see this particular issue from that historical perspective.
Thank you, Jerry. I think, we've heard, I think, all very important and sensible things, none of which I disagree with. So let me try to give you what I think is the bottom line. I think the topic of when the debt bubble bursts is a good topic. I think we need to think about that. I think there are risks out there. Karen laid out the numbers. I think when we look at this subject carefully, we'll find that it's not the aggregate. While the numbers are sexy and they're huge, I think as Karen explained, when you look at the distribution of where the debt is and what's going on, you find that it's not the aggregate number that's the issue. First, we have to remember, not all debt is bad. Debt isn't necessarily bad. People borrow for good reasons and make good use of debt. The public sector borrowings that Karen described helped provide recovery. The corporate sector would be in much worse shape if the public sector hadn't done that and hadn't provided, in the United States, a way for the private sector to delever. And that happened very significantly. And you also have to look at the setting in which people borrow. People can borrow at very low interest rates. So you can't compare debt to GDP when interest rates are low with debt to GDP when interest rates are high, because it's serviceability that really matters. So the composition of this debt across countries, but also looking within a country at what the debt's been used for and what the serviceability really matters. So to me, the bottom line is that there are pockets of problems in countries. The aggregate numbers, apart from China, the debt numbers are high. I think there are reasons to believe China will keep that under control. But let's talk, so I'm not hugely worried about that. But if you look apart from China, the aggregate debt numbers and debt to GDP numbers with today's interest rates don't seem to be worrisome. But I think there are good reasons to be concerned. There are pockets of debt that are held by companies that really don't have much servicing capacity. We use as a proxy interest coverage ratios, EBITDA, what kind of coverage there is of interest that you owe. And there are countries where there are pockets where that's rising. And I think that's going to be a problem. There is, as has been mentioned by others, vulnerability to macroeconomic changes. It's one thing in this interest rate environment, but if interest rates were to rise, say pro-cyclical, it's not really happened, but if pro-cyclical expansion in the United States had pushed up inflation and forced the Fed to tighten sharply, that would change the debt servicing situation very substantially. A recession would change the debt servicing situation very substantially. If you're in another country like Felipe's and you've borrowed in dollars, then the question is not only what's the interest rate, but what's the exchange rate. And so you have interest rate and exchange rate risk. Again, to really know what's going on, you have to ask whether companies who are borrowing have natural hedges or not. And there are places where people are borrowing in dollars, but in Turkey, the construction industry borrows in dollars, but it's building houses and other kinds of commercial real estate. So one does have to look, I think, at the composition and at the vulnerabilities more closely. Then there's the question of the vulnerabilities of the lenders. And it really makes a big difference. I mean, we care about corporations, of course, but if the consequences of a debt bubble bursting is that your banking system collapses and you have to go through again what we went through, that's one thing. If the consequences are that a lot of people who put money into through asset management companies into corporate bonds, there may be reasons that the decline in prices will be amplified, and so the wealth effects will be amplified. But it's a different category of problem that investors' wealth will go down than that, say, your banks might collapse and you'd have to bail them out. So, when we look around the world, we look at as an important aspect of whether the corporate debt is risky, whether the banking system in the country is exposed and what kind of capital coverage they have and what's likely to happen there. So again, I think then when you get to the point that you asked Felipe about the policy questions, I think the kind of bottom line that I'm talking about of looking where the pockets of vulnerability are tells you what policymakers should be looking at. I think not only would a recession be bad in this respect, but the world is not ready really to fight recession. We don't have the monetary policy space, the fiscal policy space. In the United States and Europe, there are legal limitations on bailing out banks. It's important not to have a recession. It's also important if you're worried that there are large pockets of in your country of corporations that might not withstand a recession, to keep your macro policies on a steady keel, and that means not having pro-cyclical fiscal policy. If your banking system is weak and you're worried that a weakness in corporations, defaults in corporations will cause a banking crisis, you want to do something to strengthen the banking crisis, and you want to do it now. If many countries are thinking about or experimenting with pro-cyclical capital buffers, policies in that area can make a lot of sense. And the harder one is about movements of the dollar. There, I think we believe that currency fluctuation is really a part of providing buffers for changes in the global economy. So we certainly wouldn't want to monkey around with that. But we would like to see countries like Turkey, other countries that have a lot of corporate dollar borrowing, be taking a very close look at what the business models of the borrowers are, whether they are exporters who really are essentially hedged or not.
Thanks, David. We'll want to open up for comments and questions in a minute, but I want to come back on a couple of quick things, actually both to David and to Felipe, the Minister. After the financial crisis 2008, an extraordinary amount of regulatory apparatus was put in place, which was largely directed, obviously, at ensuring that the banking system was properly capitalized, properly prudentially regulated, that we would avoid the kind of risks and disasters, frankly, that occurred 2006, 2008. And picking up a little bit on what Josh said, that's reflected in the fact still that the banking sector generally in much of the world varies from place to place. The United States is probably particularly strong, Europe perhaps less so, but it's clearly in broader, much more sound condition than it was then, and it's probably been at any point in the last generation or so. I'm wondering, Minister and David, if you want to comment briefly on this, if you would, whether, given some of the things that David has talked about and some of the risks that there could be depending on adverse macroeconomic developments or some other aspects, is there a need for tougher regulatory prudential measures in this area in particular? I mean, has enough been done? I mean, again, no one thinks this is going to be on, if this does burst in the terminology, and I take Josh's point that we don't have the conditions that would lead to that, but if we did get to that, no one thinks we're going to have another 2008, presumably, but it could have very adverse consequences. Is there a need for heightened regulatory activity to deal with this?
I think that for the most, and this cannot be a completely generalized answer, because I don't know the realities of all countries, but I think countries have been moving in the direction of higher standards for banks, like this Basel III. Basel III is a very significant increase over the previous standards, and most countries are moving in that direction. So to have better capitalized banks, better regulated banks, to have issues, prudential regulatory measures, like, for example, loan to value. David pointed rightly that you have to look at the debtor and you have to look at the borrower and the creditor. And if banks are reckless in terms of lending, if they lend 100% of the value, when you have a small decrease in the value of property, let's say, could create a banking crisis. If you have loan to value, in our country, for example, we have a 20-80, 20% equity that you need to have at least. So you You lend up to 80, but you don't prohibit, but you just make it very expensive to lend more, you know, because of the provisions that go, if you go over 80% of the value. So in that sense, you're providing the market with some guidance so that they would, you know, consider this issue. One other issue, and again, David mentioned the issue of Turkey. I think it's reckless that the banks borrows in dollars to lend to housing, you know, because a currency crisis will render those loans uncollectible, and then it will likely trigger a banking crisis. So I think that, you know, loan to value, currency, you know, reducing or, you know, or maybe eliminating currency risk. In some cases you make the decision to lend, but the currency aspect of this could create a financial crisis that had wider repercussions than just on your bank.
I mean, Josh, you mentioned, I'm struck by what you said about some of these covenants that were drawn up that sound a little bit like the kind of corporate bond version of the kind of liar loans that we were familiar with in the US housing market, infamously in the late 90s and 2000s. Now, look, I realize that this is a different, and David points that out very well, that the risks here are not of a systemic, don't seem to be systemic in nature, again, as they were in 2008, concentrated in major financial institutions which could literally collapse the world economy. But they may be, exactly in the way that David points out, through very, you know, the spread very thinly, but nonetheless potentially very painfully for a lot of savers around the world. Is it? I'll ask you first, Josh, and I'll ask David. I mean, how is it a big enough problem? Is the market dealing with it itself, or do the regulators need to take a closer look at some of these things?
I don't think regulators need to look at it at all. I think the market, I think it's just a pricing problem. There's a price for risk. Investment grade loans never had any covenants by and large. Nothing. Loans can go down in value and they pretty much can't go up in value unless they're non-callable for a period of time. So I'm not that worried about that.
David, do you
I think they're just priced very fully.
Do you agree that the market is essentially taking care of these risks?
I don't know entirely what to think about the leveraged loan covenant light segment in the U.S. You know, it's $1 trillion. That's a big number, but it doesn't feel like a big enough number to bankrupt banks, unless the scenario is really a very substantial change in macro conditions.
I think the loss exposure on that $1 trillion, frankly, is a pretty small number.
Yeah, I think that's probably right. I'd come back to I wouldn't want to warrant that we won't have a banking crisis, but I think put it this way, the more we make banks safer, the less likely it is that we have a banking crisis. I think that there's been a bit more attention to the question of what could go wrong in this ever-growing non-bank, what people used to call shadow banking sector, where a lot more of the intermediation is now taking place. And it comes back to the very important point that Josh made. Is there liquidity transformation? And I think, is there leverage in that segment or not? We know large parts of it are really very simple. You know, someone puts their money into a mutual fund and they buy the S&P 500 or they buy some U.S. Treasuries. But there are many other parts of it that are getting increased, that are part of the reach for yield that Josh talked about, and where the one thing I would say is the question is whether people know what they're getting into. You know, we have the suspicion that everyone believes that your money in Vanguard or BlackRock or any of those other places can be called, but it may well be that if everyone does it at the same time and those institutions to liquefy start selling their assets, that you get a kind of amplified asset price decline that leads to a kind of run, problem that would be rather similar to what made the banking problem much bigger than it needed to be, that it was very hard to value assets or to know whether the asset price movements were fundamental or part of a kind of a run mentality. So then you come to the question of, should the regulators be doing something more with respect to the non-bank sector? I'm not convinced yet. I think it's worth knowing more information. I think it's worth making sure that, in the case of the complex mortgage products, part of the problem was customers didn't really understand the complex products that they were being sold. They didn't understand the implications of the puts in the auction rate securities market and various other segments. It may be that we look back on this 10 years from now and see that people investing in some complex products didn't know quite what they were getting into. And so helping people wise up would be helpful. Now, on the other hand, in a search for yield environment, to some extent people know they're taking a flyer. And so it may be unavoidable.
Karen, please.
So just a couple points. I think banking regulation has been brought up quite a bit. I'm probably the only one on the panel that has lived with banking regulation for the last decade.
Fun, isn't it?
I will tell you there has been regulation on leveraged loans. There has been a lot of regulation on, capital, right? So Basel III, advanced is not enough. We have to have Basel III standardized, and you have to take the worst of two to measure yourself against, and that's not good enough. If you are a globally systemically important institution, GSIB, you have to add an additional capital buffer, and most U.S. banks, we're pleased to report, are well above that buffer. So you have that, and then as if that were not enough, we have to look at a supplemental leverage ratio on the capital side, and then liquidity. This is actually a very important point to the subject. Liquidity coverage ratio was also introduced. Liquidity coverage ratio really only give you credit if you hold extremely liquid bond instruments, really sovereign bonds or agency bonds and things like that. So owning corporate bonds on the balance sheet is a stupid idea to satisfy your liquidity coverage ratio. So that got that taken care of. Then you look at the Volcker trading rule, which Josh brought up, basically saying you have to have this REND limit. What is that? Reasonable expected near-term demand. So you can't really hold more inventory on your balance sheet unless you can justify that's for reasonable and near-term customer demand. You're not supposed to be doing prop trading. We got that. So a variety of those regulations contributed to less inventory on the balance sheet, obviously, liquidity gaps. But when you think about leverage and lending in particular, OCC, we have 3 regulators in the US. We have the Federal Reserve, we have OCC, and we have FDIC. So when you think about OCC, they have introduced extremely stringent leverage lending guidelines, which if you look at the corporate spectrum, basically the bottom third, we're not really supposed to lend and hold on balance sheet. So if you look at the bank's balance sheet, at least in the US, it's quite pristine. So the assets are extremely high quality and very conservative. So, and I guess the last point, if you think about it, proof is in the pudding. So who owns these US corporate bonds? It's roughly $10 trillion. Number one, you're not gonna guess this, because I didn't know this before, foreigners. And that roughly is 26-27% of US corporate bond market right now. And I can point out a few Asian countries, for example. Number 2, mutual funds and ETFs. And we can have a debate about if ETF is actually helping or not helping, because I think the jury is out. And number 3, insurance companies. And number 4, pension funds. Banks, not on that list. We're not owning these corporate bonds. So I think the financial crisis has taught us a really important lesson. And financial crisis, I think Josh just hit the nail on the head, is that we own mortgages on the balance sheet. Those are long-term illiquid assets when liquidity gaps occur, and we have shorter-term liabilities. So we own mortgages at the time, but now it's a totally different environment where we don't really own these instruments. So for this particular subject, I think the asset liability mismatch doesn't really exist.
Thanks, Karen. I'd like to open it up. There are already some hands shooting up. The first one I saw was gentleman at the back. Yes, please, if you'd wait for a mic, that'd be kind. Could you identify yourself, please?
It's not working.
Sound problems here
Someone turn on
today.
his mic.
Sorry.
Maybe you just shout.
Hello?
There we
Yeah,
go.
sorry.
Could you identify yourself, please?
Yes, Daniel Sachs. I run a credit investment firm in Northern Europe. So I have 2 questions for the school friends. So Josh, if we look at the covenant light phenomenon, not from a systemic point of view, but if we look at in Europe, for example, before 2007, 5 to 10% was cov light. 2008 to 11, we had 0% cov light. Last year, we had 87% cov light in the leveraged lending market, and the bond market is similar. This also means that we'll have less defaults in a crisis, because non-payment is really the only thing to wait for. How do you think that's going to affect credit markets if we get a cycle with kind of walking dead? And then just to David, on the regulation of non-bank lending, and I'm part of that market, I agree with you that there's not a lot of systemic risk, but there's also very little transparency in terms of leverage and maturity transformation. That could be another reason to regulate. What is the discussion with your peers in the regulatory community? Is this something that is likely to happen or not?
Thank you.
The numbers I know are a little bit different from yours. I think Cov-Lite was hitting around 30% in 2007 before the crash, but it doesn't really matter. What's interesting, though, is that the CLO market, which actually owned tons of Cov-Lite bank debt on major leverage, 10 times leverage, but there was no mismatch, sailed through the financial crisis without a default. Pretty remarkable, including some pretty mediocre managers, in my humble opinion. I mean, there are some mediocre, they have to be by law of statistics, there's so damn many of them, but none of these things defaulted. But that's because their liabilities never got called. Now, you could argue today that they're being more aggressive in terms of the way bank debt's being structured, that there's more flexibility of sponsors to do things that are abusive to bank debt, that poorer quality companies. That's the business cycle. As long as you don't have those key central institutions that are carrying all that leverage, owning things that are a problem, there's a limit to how much the government should be protecting investors from their own foolishness. In my view, you just have to be highly discriminating on what you buy, and I think the pricing wasn't very good at protecting you from the types of consequences of giving that kind of latitude to a borrower. And so the par loan market wasn't so interesting. We saw a little bit of that correction take place in December, and we saw prices for bank loans all over the place drop by 5 points. And now you add the discount plus the spread off of a LIBOR that's actually a real number instead of zero, and you have the extra margin, and all of a sudden there's an enormous rate of return that you can earn on some of that bank debt if there's just a little tightening in the market. So yes, there's a risk, but there's a pricing of that risk, and I think that's the nature of the market. I think markets are pretty good at correcting those things, generally speaking. It's a little more difficult to have the markets correct those when the government is constantly, and for good reasons and well-intentioned reasons, constantly in the market with quantitative easing programs and with the Fed buying paper. It's very, very hard, because that's what people are competing against. When the Fed backs out a little bit, all of a sudden the market has to find the prices of risk assets without that sort of independent standard sitting there.
David, do you want to respond particularly to the regulatory question?
I just answer. I mean, the reg reform basically said that if you're acting like a bank and you cause systemic risk, you can be brought to the regulatory perimeter. But that said, I don't see much of a move to broaden the regulatory perimeter very substantially to cover what the main categories of non-banks, because where people look, there doesn't seem to be much leverage, and there doesn't seem to be, I mean, there's some maturity transformation, but the risk stands with the investor. BlackRock doesn't put its capital at risk when it invests. So I don't see that. We always want to know more and look more and more closely to understand the nature of maturity transformation, liquidity transformation in the non-bank sector. If we learned that there were emerging risks, we'd probably want to take a closer look at them.
More questions, comments, please. Yes, sir, here. Please identify yourself.
Yes, hi, I'm Daniel Belfer from J. Safra Serzin. I think the panel made a very clear point about the bank's balance sheets and how they've improved. To what extent should we really worry about the market structure? I mean, the amount of passive investing in fixed income has gone up a lot. Bond trading volumes have gone down a lot, and the amount of BBB debt relative to high yield, for example, has gone up tremendously. One investment bank says it's gone up from 2.25 times to 3 times in the US and 3.5 times in Europe. So to what extent, when the recession comes and we get the usual downgrades we usually get, do we have this indiscriminate selling affecting markets?
Question. Karen.
Sure. I think make no mistake, we're definitely not saying on the panel that you shouldn't worry about it. I think all the points that you made are extremely valid. Investment grade universe in the U.S. is roughly $7 trillion. 40% now is BBB, and that's roughly close to 3 times leverage. To your point, it's gone up relatively quickly. It used to be 1.7, 1.9 times. So that is a pretty alarming increase in terms of just the leverage that's in the BBB space. And obviously, we've seen multiple defaults directly out of the investment grade, just directly to default. I mean, you've seen Enron, you've seen Lehman Brothers, you've seen MF Global, and just a few weeks ago we had potentially PG&E. So I think when you see this type of trends on investment grade, you're supposed to go to high yield, or if you get downgraded, when you go directly to default, you do get a little bit worried about the fundamentals, right? I mean, GDP growth is coming down, earnings growth. I mean, that's actually, I don't know, if you knew this, that the Q3, I think U.S. earnings growth, EPS growth was 20%. It slowed to 6% potentially in Q1. So that's a drastic, slowdown. So in terms of earnings, obviously there's a lot of tail risk concerns. We literally have 4 brinksmanships going on right now on the macro basis. You have, government shutdown in D.C. That's a brinksmanship. You have Brexit. You have the yellow vest versus, the Macron, and then you also have the U.S.-China trade war. So macro definitely drives micro right now. You can definitely do a lot of fundamental analysis, but I think any of these macro tail risk factors move, your markets move. But to answer your direct question on, so we definitely think there's concerns default rates are picking up. I think high yield default is, high yield market size quadrupled in the last decade. And that's $2 trillion market. And that default rate is probably picking up from 2%, 2.5% to now potentially 4 or 5%. So that is being, that's already materializing, right? Because fundamentals are getting worse. But when you think about supply and demand, the reason I went through different categories of purchasers and holders of these debt is that, mutual funds and ETFs, to your point, and I think Josh made an excellent point, and potentially for sellers, because obviously they have inflows and outflows, a very technical thing to manage. But obviously they're not the largest group, and you have 3 other groups potentially balancing that. And I think the market structure is evolving. The electronification is happening. 25% of investment grade bonds are traded electronically, which, depending on which side you stand on, does that exacerbate problems in a downturn, or does it help with liquidity and provide a circuit break? I mean, that's, again, I think the debate is ongoing right now. And 15% of the high yield bonds are traded electronically. So you have to think about, banks used to provide liquidity and make markets. Now it's not just the banks, it's ECNs, it's market access, it's a lot of these electronic trading venues. So we have to think about the fundamentals, on a macro basis. We have to think about supply and demand, and think about the trading venues, and think about potentially, these technical issues as well. So I think it's a pretty complex issue.
Karen, thank you. Well, let's move on. Yeah, because we've got some more questions. Yeah, another gentleman at the back there.
Hi, Qasim Kutai, CEO of Nova Holdings. Just Karen, picking up on your point, I think there are red flags out there, but it strikes me that there is every reason to make sure that we have a soft landing rather than a bubble or a crisis. The reason is growth is slowing down, but we still have growth. Tightening is taking place, but much slower than anyone thought. Interest rates will probably not rise as fast in the US as we thought a few months ago. Europe, they probably seem on hold. China, you've mentioned. So there's a real, it seems to me that there's a period, we have a long time to adjust. So isn't this really a test now for regulators, for central banks to step up and say, the red flags are there, but thankfully we've got time to adjust. Isn't this time to, and I'm not sure how it would work, but to send signals to a B of A and say, no debt issuance to a sub-investment grade company that takes it to 7 times coverage, debt, or what have you. Maybe there's some other measures, but it strikes me that if we use the space that we have to make this adjustment in a gradual way, then I think we could be in a pretty good place.
Do you want to respond quickly? And others too. It was addressed to you, Karen, but you want to...
I definitely agree with you. I don't think there's a systemic crisis. I think, maybe the panel agrees as well. I definitely think there's going to be fundamental issues out there, to your point. And I personally am not, I'm always optimistic. I definitely am not in the, end of 19 recession camp for sure. And I think we do have time to adjust. And I think many of these macro factors have to play out as well. And I think regulation obviously can always be tweaked, but I think regulation has played a very important role so far. But on leverage, lending guidelines, I'll let David and
yeah. I mean, none of you seems to think, responding to that question, that there is, as Karen says, however we characterize what's going on, there is systemic risks that require regulatory, significant regulatory action beyond tweaks. Is that fair?
Look, I think that there is a rather fundamental question about public sector role. Josh raised the question of whether you should protect investors against making mistakes. The approach that was taken before the last crisis, which didn't work, was to try to regulate the banks. Tim Geithner went through a whole project, the Corrigan project, to see, after LTCM, it was clear that there were hedge funds that were going to get in trouble. And the question was, do you regulate hedge funds? Well, hedge funds are individuals, and if they want to risk and lose money, they can, was the philosophy. So what you want to do is you want to regulate the banks who lend the money to the hedge funds to make sure that the banks don't go broke. Well, we missed an awful lot of things that banks were doing that were risky, and so that approach failed. But you still have the same fundamental question to go to address what was asked. Do you do something about corporations that go on borrowing, even though they don't have very substantial earnings, borrowing money from people who are willing to lend them money? Or do you just hunker down and make sure that the banks are sound? Maybe put in place countercyclical capital buffers, or batten down the hatches in other respects to make sure that when people go broke, it's their own losses and it doesn't become a systemic problem. I'm not saying that that's the right answer, because I think we failed before.
I'm just wondering, maybe you can ask, what's the public interest if a bank is, if a company is continuing to, borrow excessive amounts and people are continuing to willing to lend to it? What's the, you explain, what's the regulatory, what's the regulatory obligation there?
I think you have to do exactly what David says. Who do you bring within the regulatory circle? There's no prohibition on allowing an equity mutual fund to pay some insane amount for some stock,
right,
and then watch it decline 50%.
Right.
We don't say, oh my God, we should regulate the mutual funds. Oh,
right,
we should have the government insure these poor investors.
Right.
We do say that you can't have fraudulent financials.
Mm.
We do regulate what you say to the public when you're the CEO, and when you're not the CEO, when you're the CFO, and you're making. We have all sorts of regulatory
just David, let's just
a quick sentence.
Sorry.
Look, the conceptual point is, if there's an externality, you regulate. If the banks were providing leverage, thinking about their own survival and profit and losses, but not realizing that if everyone was doing it, the whole system was going to collapse, there's an interest in trying to make sure that they internalize the externality. But if it's just company A borrowing from investor B, and there's no externality, I think there's less of a public role.
Felipe, you wanted to say quickly something?
Yes, I think the first thing is that, yes, when you regulate, when you think there's an externality, you also regulate in particular, and you have special regulations if you regard there is systemic risk. One thing is a failing, if a company fails, maybe that's nothing to do with public policy, the failure of a company. Unless it becomes big enough that it jeopardizes the system, it jeopardizes the banking, the financial system. I would like to point out to a couple of things. Non-regulated, financing, I think shadow banking, but also, whether in a concept, there are many countries, like you have seen the explosion of car loans, car loans, and they are unregulated. And suddenly there may be a bubble on car loans. So you have to be always looking at where you should need to be to have an eye and to bring it into the regulatory circle. On the issue of, David mentioned the issue of counter-cyclical buffers. Well, Basel III has counter-cyclical buffers. You have special types of,
Right. It's the question of whether people want to invoke it. Central banks have to decide to invoke it.
Sure. So maybe if you have the Basel III, that's the first start, and then of course there are periods too. But I would just like to say one more thing, which is important. When we look at this, sometimes there is certainly a role for public policy here, and I don't take the view that we should regulate everything that moves. We should let private enterprise, move and try to create and not be a hurdle on the way, but there are ways in which, the unregulated markets, will bring a problem to the system. I think and one other thing that we have not discussed, we're thinking about a recession. And we say, well, yet we're not in a recession, we're just in a growth slowdown, so nobody in the panel really thinks that we're on the verge of collapse, or a bubble that will burst. But we should also take the view, and I take the view from public policy, that we should do more to reinvigorate growth. Because after all, this is debt to GDP. It's not just about the absolute increase in debt numbers, whether you're really doing to do some structural changes in the economy that will increase your potential growth and your current growth, so that the debt GDP numbers, you probably won't cut debt GDP numbers, you just stabilize, them in time. Maybe, you don't cut the absolute debt, but the debt GDP if you're able to reignite growth.
Thanks, Felipe. We've got time for a few more questions, and I do want to get...
Can I just add one?
Yeah, very quickly,
Okay.
if you would, yeah.
So I think the other thing that we didn't talk about, which is actually probably elephant in the room, is that actually private, right? So if you look at private debt, and when you think about private debt, the reason this actually keeps me I keep thinking about this question is because I don't know the answer to it. Is that when you look at the number of U.S. public companies, 20 years ago it was roughly 8,000. Today, 4,300. So it's roughly half. So you talk about financials, you talk about governing, looking at corporate leverage, whatever. So there's a lot of companies that are private. And the dry powder in the private equity sector right now for the next 5 years of investment period is roughly $1.2 trillion. And there's private debt growth as well. So there's a lot of debt and equity that's actually even away from the public space when you actually have, probably we just don't have a lot of transparency. So when you think about that and you think about the overall size, I think there's something to consider.
Thank you. Thanks for being brief. Gentleman there with the beard.
Hi, Henry Kerr from The Economist magazine. I was interested, wanted to take on this idea that the reason that you would care about the banking system, about systemic risk is just the failure of the banking system, and that if a corporate gets into trouble, it's not a problem if it doesn't pose systemic risk. Isn't it the contrary? Isn't the reason, the social purpose for regulation of the banking system that if it goes down, you might get a credit crunch which cuts off credit supply to corporates, which might then go bust and cause problems? And if that's the case, is the distinction between the banking system and the rest meaningful? I mean, the idea that investors should bear losses, you could apply that equally to bank creditors, and it didn't happen last time around. But further to that, even if we did buy the view that it's just the markets can sort it out in advance, what should the appropriate policy response be after a sharp repricing of risk? Is the implicit view it's just monetary policy's job to sort it out by cutting interest rates enough?
Thank you.
Look, I think you're absolutely right that the reason why we care about the soundness of the banking system is that if and when it fails, it affects the economy more broadly. Now, if all corporations had so much debt that they were about to fail, one could make an argument that the whole economy would come crashing down. But I think it's more likely that we will see pockets of problems. There are a set of companies in the United States and several European countries where the interest coverage ratio is below 1.5, and they're, I think you could assess the probability of default for those. The failure of those companies is not something that would, it would affect the GDP, but it's not something that would be systemic to the economy. So I think it does make sense to try to make sure that the banking system is sound. That's where leverage can be, we know from the past, leverage can be granted without anyone taking account of how it all adds up to increased systemic risk. I don't think that the corporate debt problem in advanced economies and in most emerging market economies right now is of that same order of magnitude.
Thanks, David. Any more questions, comments, observations? No. Just very quick summary then, if I may. Correct me if I'm wrong, my overall impression is that, again, as I said earlier, we understand the scale of this, of what's happened to corporate debt. Because of the very nature of corporate debt, because of the disintermediated nature of debt, there doesn't seem to be a systemic risk, financial risk, systemic risk to the financial system. What are the, just very quickly from the panel, as we go through this next year, and we do expect, I mean, we could see some of those macro events that we've all been talking about. We could see higher interest rates, although there are expectations of that are dimming slightly. But if we don't see that, then the risks of a demand shock, of a recession, could be quite significant. Very quickly, each of you, if I could ask you, as we go through the next year, what should we be looking out for in the course of the next year in the corporate bond market? Can we expect to see the kind of some of the sort of short-term distress that we did see in 2016? And if so, what are likely to be the implications and the policy responses? Karen, quickly.
Sure. So I think, one thing that David brought up that's very, very important is I think now it's the era of fundamentals. You have to really look at, it's not a beta, rising tides lift all boats anymore. You're going to have to understand the corporate balance sheet. You have to understand the fundamentals of a corporate credit that you're actually buying. And you have to really do work. When you look at developed countries, I think, the companies with less than 1.5, using David's number, debt service coverage ratio is roughly 10%. When you look at emerging markets, corporates, you're looking at roughly 20-25%. The issue is, what if the Fed is not on pause? What if we come out with all of these macro events, fantastically, and we all of a sudden are going back on a hiking cycle, and interest rates go up 200 basis points? That's what I think about. And I think that's when you potentially have companies being pushed into a riskier category, and using that 1.5 debt service coverage ratio as a guideline. And then you will see developed countries having 10%. Right now it's 10% of the companies. That will go up to 20%. For emerging markets, that will go from 20-25% of the corporates to 35-40%. So that's where I worry about, is this interest rate sensitivity. We talked about currency hedging. We talked about, so you have to understand interest rate risk. You have to understand currency risk, credit risk, and all of those things. And I think that's very, very important.
Felipe, you're a policymaker. You're paid to worry. What do you worry about?
Well, first of all, I would look at the issue of how is growth moderating. How fast is growth moderating? Because if you have a very substantial moderation of growth and you have significantly slower growth, then things are going to get more complicated. The issue of interest rates that you mentioned, Karen, is very important. What's the pace of increase of interest rates? If there is this, moderation in the pace of it, it will help also, to cushion the circle and to cushion this cycle. The other aspect, and I would take the view for all emerging markets, and not only emerging, but our commodity exporters. A slowdown in China that has significant effect on commodity prices will be a cause of concern. So this is the kind of thing that we would be looking in not only in my country, Latin America, with a very few exceptions. They're mainly commodity exporters, and if you look at Middle East and countries in Africa, commodity exporters. So you have even industrial countries which are having, Australia, New Zealand, commodity exporters. So I think the issue, China has such an amazing and a big effect on commodity markets that is way beyond their weight in the global economy. That for us is a very important issue.
Josh, your thoughts?
I would expect continued volatility, and maybe much more heightened volatility, especially in the non-investment grade markets. I think you continue to have the structural fragility of the market that you saw, driven by passive funds and index funds. So I think you have that mismatch of assets and liabilities, not leverage, so I don't think it's systemically bad and not located in any of the intermediaries. But and in fact, you're talking about regulation a little bit, and to some extent, the regulations prevent the banks from performing one of the jobs they perform, which is providing liquidity. So when you have less liquidity and you have mismatches of assets and liability in mutual funds, the fragility gets exposed quickly when rates start to go up. And so you have to watch those exact factors in the real economy, and that laundry list of unaddressed problems, from Brexit to trade to, and so on and so on. And you have to look at growth, and you have to look at commodity prices. And I think the effect of those can actually have a pretty material effect. The last thing I would say is that one thing that was demonstrated with the Fed raising rates was that the ability to fine-tune from the government's point of view is actually somewhat limited. I don't know what fiscal arrows left in the quiver after the tax cut. You can't all of a sudden, I mean, you have to watch government debt too. We talk a lot about corporate debt, but government debt is the place where the debt's been accumulating. And clearly, if you take your foot off for even a second in monetary policy, it has a pretty extreme effect. So I think we have to be more focused on those real factors and the structural factors of the market.
Thanks, Josh. Last word, David, briefly.
I think Josh is right that fragility has really risen, but as in many things in economics, the macro usually matters the most. We've been saying that countries should fix the roof while the sun is shining. That's all the more the case when your corporations, where corporate debt is a fragility. It's all the more the case when you know that policymakers have less policy space, whether monetary, fiscal, or otherwise. So the most important thing is to keep economies on an even keel, as Felipe said, try to provide a better growth environment and avoid the next recession. Certainly avoid, if and when it comes, it being something worse than a garden variety recession.
Thank you very much. We'll be back next year then with when the sovereign debt bubble bursts. But in the meantime, I'd like to ask you to join me in thanking our panel. It's been a very long day and we're very grateful to you.
Harry.